Hello, Michael Shotnik with Sierra Pacific Mortgage. Hope you're doing well. Reaching out regarding a concept and a question I get quite a bit, and that's just kind of where is housing going? What are we going to see over the remainder of 2022 and beyond? And I've actually spent a lot of time talking to a lot of individuals trying to put together kind of my thoughts on this. And really quickly here, I'm going to talk you through what we've seen and what I think we will see over the next handful of years, and hopefully the information is helpful to you. Let's jump right in. As we know, it's been chaos, and hopefully this picture kind of exemplifies that. We've seen bidding wars, rapid appreciation, lotteries for homes, so really just kind of chaos. A lot of reckless offers in there, and kind of an uncomfortable environment if you're a buyer trying to purchase. Ultimately, let me back up here. Values are at or near all-time highs, and the concern becomes: is this sustainable? Can we continue on this just crazy tear? And I really don't think we can. I don't think we will, and let me explain why. So the big concern is, the 2008 housing crisis. Are we going to see that again? Is the primary question here. If you go back to 2007, you can see leading up to 2008. And just that huge decline in the stock market, in the real estate market. It was a terrible time for all involved. And there were a handful of things that led to that. That was risky lending, which created this kind of artificial demand. People who had no kind of reason to be in an ARM or a loan with a balloon payment were being put into those loan products. And then ultimately, lending standards were super low. So someone with a pulse, someone who could breathe, could qualify for a mortgage. In addition to that, about the time the mortgage turned, a lot of the market was 100% financed, and they had no equity in their home. The market turned, and they couldn't qualify to refinance the loan. One, because they're upside down. Two, because lending standards changed. They could no longer qualify for the mortgage they were in. And it quickly led to a situation where foreclosure, default, those were the only real options. So what is worth illustrating here is, we can go all the way back to 1900, but really kicking in 1940, we started to see really pretty steady increases in home prices. And then 1980, you can see higher and higher and higher until we hit that 2007 mark. This would have been, I think, a pretty nice, steady increase of appreciation. However, for the reasons mentioned in the previous slide, we saw this spike and then this quick correction to really kind of the average here. So what's worth pointing out here is 2008 to 2012 are really considered, in my opinion, to be an anomaly. I don't think is a very good indicator of what's on the horizon. It was outside of the norms, again, for the reasons mentioned. So what's on the horizon? Are we going to see a repeat of 2008? Are we going to see rapid appreciation? Are we going to see any sort of depreciation? Are we ever going to see a buyer's market again? And ultimately, how does inflation impact this? And I think it all starts with a simple concept, and a very powerful concept, and that is supply and demand. This is the relationship between the quantity of a commodity that producers wish to sell and the quantity that consumers wish to buy. So ultimately, the question becomes, where's demand going and where's supply going? First and foremost, millennials are now buying homes. They're at that age, call it 26 to 32 years old, where they've delayed, but they are moving out of mom and dad's house. They're having children being a very big catalyst to purchase a home. And when you compare the size of their demographic to, say, the baby boomers, they are a bigger demographic in numbers than the baby boomers. And we all know the baby boomers were a massive force financially in the market in a good way. And we're getting into this demographic that exceeds that. So there's one kind of aspect of demand that will be very powerful in the market. Secondly, builders and existing home supply just is not keeping up. If we look in the middle here, that is a balanced market. And when we see in the blue line, we're down 24%. And this is a touch outdated, but it still applies. Existing homes are far below demand, along with kind of builders being below demand. Builders cannot keep up because of supply chain issues, labor shortage, and ultimately the cost to build a home. In addition to this, What we would have seen potentially is a housing crisis through COVID, but through the CARES Act, forbearance was very, very easy to obtain for homeowners, meaning if their income were affected by COVID really at all, they could defer their payments for 6 months, 12 months, an extended period of time, helping them kind of bridge the gap through COVID and staving off, a housing crisis. So what we may have seen there is a lot of homes selling, so a bunch of supply dumped into the market. We just didn't see it. So here's what I think we're heading into right now. We're in the buying season of 2022, and the market is still very active. We have these demand forces in the market. We also have inflation working against us, which is driving interest rates up, purposely so by the Fed in part, because prices are out of control and have gotten to a point where the Fed has to act. So when we look at where we anticipate going from beginning of 2022 into 2023, this does not indicate any sort of depreciation of home values. It just indicates a slowdown of appreciation to historical norms being about 2 to 5%. It's anticipated that into 2023, that's about where we're going to settle, is in what I think is a healthy 2 to 5% range, which is a really, really good thing. Homeowners aren't going to see the 10 to 20% appreciation rates per year, but it will be a more balanced market where people are not writing reckless offers to get properties under contract and or putting themselves maybe in a tough position to purchase a home. It'll be I think, a more controlled scenario where individuals who have been considering, say, making a contingent offer, so transitioning out of a home they own into a new one, I think there'll be opportunity there. So long story short, I do anticipate, because of demand still exceeding supply, a more balanced kind of relationship there, but still exceeding supply, via builders still can't keep up, so demand will stay high. Forbearance held the dam. Fixed rate loans are dominant. So, I think that's a big aspect versus 2008, which will allow us to hang on to kind of the stability. I don't think we'll see a fallout in the market. And then common sense lending. And also, most homeowners have a significant amount of equity in their home, which ultimately gives options. So when we see a housing collapse, it's generally because people, have to dump their homes into foreclosure. They do not have any equity or any options. That's another really strong aspect to this. So long story short, I think we'll get back to healthy levels. It will be an okay time to sell, a okay time to purchase, just kind of that average position to be in, which is good. And we should be there based on the analysts I follow, into the foreseeable future. Things can always change. If we see interest rates up near, say, 10%, I think that could have a huge impact, of course, or this war overseas, maybe having more of an impact than we're thinking it will. There's some fine print here, but again, I think we're in a pretty good spot and heading into a good spot as well. If you need anything, let me know.